and I've just shared the slides. I hope you can see the first slide, just TUT, Financial Accounting 3B, Consolidation. So today we're dealing with the last part of consolidation, and at this level, this is the most important part. Why am I saying that? Because as I've indicated on Monday, you've done consolidation now from level 2, but as you come to this level, there are transactions that we add, and the more transactions that we add are intergroup transactions. And today we're going to look at that in an exercise, especially the sale of inventory between the parent company and the subsidiary. We need to know how to account for that in consolidation, as well as the sale of property, plant, and equipment between the two companies, which is the parent and the subsidiary. As I was indicating, much time on that. Say, what is the impact when there's a sale between the parent and the subsidiary? What happens to the sales? What happens to inventory? If it's related to property, plant, and equipment, what's going to happen to the profit realized? What's going to happen to the depreciation as well, which will be charged by the other company? All right, just to recap, what we did on Monday is that when it comes to consolidation, you will be expected to know how to prepare the analysis of equity. The analysis of equity here, it will be the analysis of equity of the subsidiary. So you should be comfortable in preparing the analysis of the subsidiary acquired. And the other requirement is that you will be expected to prepare consolidated statement of financial position, consolidated statement of comprehensive income, and lastly, you will be expected to prepare the consolidated statement of changes in equity. Consolidation process, just on a high level, again, there are procedures in terms of IFRS 3 and IAS 27 as to how do we do consolidation. So if you have two companies, company A as a parent and company B as a subsidiary, how do you consolidate? So there are procedures that the standard give us. The first procedure is that we must combine the like items. So if you have assets in the subsidiary and assets in the parent, combine them. That's the first thing you do. And I believe everyone can do that. Even a grade 12 student can do that. Say, just combine, if I have two financial statements of a parent as well as the subsidiary, I'll say, go to the asset section. If the parent has assets, combine it with the assets of the subsidiary. Easiest way, which I believe you're going to write on the last assessment, the sitting assessment, I believe. Make sure if there's a consolidation question, you start by combining the like items before you do an adjustment. By just doing that on its own, I can tell you accumulate by just combining. As for example, they want you to prepare statement of financial position. And you know that you have the information for the parent and the information for the subsidiary. The first thing first, as indicated in this procedure, you just combine it. And so on to additional see is any transaction that will adjustment. The next procedures, they say we must offset or eliminate the carrying amount of the parent's investment in each subsidiary. So, example, which will be, if you go to consolidated statement of financial position, you will never see the investment that the parents made to the subsidiary. The reason is that when you do consolidation, you must eliminate it. We'll touch more on these on the actual exercise. But for now, this is a manual, this is a script. If you want to do consolidation properly, first thing first, as I've indicated, combine the like. Secondly, eliminate the carrying amount of the parents each subsidiary. And they say each subsidiary. So normally, as you go to the postgrad level, you might find that the company has more than one subsidiary. But for this level, we normally give you one. The next procedure, you go to this it. So when they say portion, they are indicating portion because sometimes you may find out that you only only controlling interest. There are two ways to measure it: in use fair value or proportionate share of net asset. Lastly, we must eliminate in full intergroup transactions. This is where I've indicated that we're going to spend more time on. So this is the consolidation process. You must know it by heart. You must know how to apply it. All right. Moving along, now we are in class example number 2. Let's start with the required. Let's start with the required. You can see that the required, if I look at the marks, consolidation normally in the exam, it carries plus or minus 30 marks. This question that we're going to look at today, it was 2019 exam. I just took the question. So the standard that we're going to look at here will be more or less the same what you're going to write on when it comes to financial accounting consolidation. So if you add these marks, it's plus or minus 30 marks, and you know that paper normally comprises of 100 marks. So there is no way that you can go to exam without being prepared for consolidation, because if you do that, that means that you're losing 30 marks. Already you're writing out of 70, which is going to disadvantage you. But let us look at the required. As I've indicated, this is prior exam paper 2019. It was written last year. So let us look at what is required. Firstly, they want us to prepare the analysis of equity of Care Limited. Well, I think when we read the actual example, we'll see that Care Limited is a subsidiary. And we must also prepare the consolidated statement of comprehensive income, consolidated statement of changes in equity. You can note here that they didn't want us to prepare the consolidated statement of financial position in this case, but you might get a question that requires you over and above analysis, statement of comprehensive income, and statement of changes in equity. You must also be able to know how to prepare the statement of financial position. All right, so those are the required, and this is the information given in this exercise, right? So as we read this information, we must be able to identify who is the parent and who's the subsidiary. As you read any information regarding consolidation, you will get that. For example, here, they're telling us that the following information concerning Penn Limited and Care Limited. At the moment, we don't know who's the parent and who's the subsidiary, but I believe as we go down with the information given in this class example, we will know. Let's read the first paragraph or the second paragraph. On 1st January 2017, the date on which Penn Limited acquired 80% interest in Care Limited. So now we know that to be parent, Care Limited is going to be our subsidiary. The equity of Care Limited consisted of share capital, mark-to-market reserve, and retained earnings. If you remember, when we were reading one of the consolidation process, they say we must eliminate equity of a subsidiary. Very interesting. We will see how to eliminate that. But what we're getting here in the first part is that Penn is a parent, Care is a subsidiary, and Penn owns 80%, not 100%. That means 20% is non-controlling interest, is what Penn doesn't own. That's why we need to do the analysis to see if there's a profit, how it's going to be shared between 80% and 20%, and all other transactions that goes on the analysis. All right, so we are also given the statement of financial position. You can see that we're given Penn Limited information and Care Limited information. What is more important for me when it comes to the statement of financial position, I want to see what is the cost of investment. How much was spent to acquire that 80%? You get it here on the assets part. Investment in Care Limited, cost price 425,000. So we paid 425,000 to acquire 80% shares of Care Limited. Very interesting, because first thing first, when you do the analysis, we need to determine the goodwill, whether there's a goodwill or bargain. Then we given also other transactions as well. We'll look at them later on. I'm more interested in the investment as it stands, and then we'll come back later on and deal with the other transaction on the statement of financial position. So now let us move to the statement of profit and loss and other comprehensive income. As well, here we're given the parent and the subsidiary. So one of the requirements, they want us to prepare the statement, the consolidated statement of comprehensive income, consolidated one. And when we were reading the consolidation processes, as I've indicated, I say, first thing first, combine the like items. So in other words, if I come to revenue here, the first thing that I'm going to do, I'll take this 3 million and add it with the 3 million of the subsidiary. That is the process before looking at any other transaction. So I'll do the same with all other line items, like other income. I'll come and say, parent is 35,000, subsidiary is 2,000. You add together when you do the consolidated statement. Statement of changes in equity, very interesting, because this is where we get the movement. If you look, we have retained earnings and we have market-to-market reserve. So they gave us information at the beginning year of 2019 because we are preparing information for the year ended 31st December 2019. So they gave us the opening balance. So retained earnings for both the parent and the subsidiary is given, and we're given profit for the year as well. I believe this profit for the year, it should correspond with these amounts here. They just transfer it to the statement of changes in equity. Then other comprehensive income, then dividends declared and paid. Dividends declared and paid. So we'll wait for the additional information to see as to if the subsidiary declared 40,000 of dividends, how much went to Penn? Remember, every investment, every company, when they make investment, they're expecting to receive dividends, which makes sense. If I go and buy shares at Vodacom, let's say I invest 100,000, what I'm expecting at the end, I'm expecting to get dividends. So Vodacom will say to me, your 100,000 can only give you 5 shares. I'm just giving an example. So I expect dividends of that percentage of shares that I have. Let's say that 5 shares is equivalent to 5%. So whenever Vodacom declares dividends, 5% will be coming to me. So coming back to this exercise is that here we have Care Limited and the dividends declared and paid of 40,000. So if you take this 40,000 and multiply by the percentage we own, which is 80%, then 32,000 of these 40,000 is coming to us, and the remaining 8,000 is non-controlling interest. And I must say it up front again here that dividends between the parent and the subsidiary is an intergroup transaction, and according to the principles of consolidation processes, it must be eliminated. We'll touch on it when we go to the calculations. But I just wanted to state that when you read this information, especially on the statement of changes in equity, once we see dividend declared and paid, it must come to your mind that, okay, if 40,000 is declared and PEN own 80%, that means 80% is coming here, and that 80% is intergroup transaction and it needs to be eliminated. Additional information, this is where we get all the information that we require to do any adjustment when necessary. Additional information number 1, they're indicating to us that at acquisition date, the directors were of the opinion that the non-controlling interest share were worth 137,500 based on current share industry prices. Remember, when it comes to non-controlling interest, you can measure it in 2 ways. You can use fair value, you can use share proportionate of shares. So now they gave us the amount, say the fair value of non-controlling interest was 137,500. This is what this additional information number 1 is telling us. Additional information number 2, other income in PEN Limited consisted of dividend income from Care Limited of 32,000 and finance income of 3,000. So this additional information is talking directly to this statement of changes in equity. I've indicated that the full dividends declared and paid was 40,000. We own 80%, so that's why they're saying it's 32,000. If you take your calculator and you take 40,000 multiplied by 80%, it should give you 32,000. So this is dividend income from Care, and I've indicated that dividend income between the parent and the subsidiary needs to be eliminated because it's an intergroup transaction. This is what they're telling us. The same will apply to finance income. The same will apply to finance income. We'll see when we do the actual statement of comprehensive income as to what is the impact. But I can tell you now, when you go to other income on the consolidated statement of comprehensive income, we should be able to see the dividends amount of 32,000 deducted. Why is being deducted? Because it's an intergroup transaction and intergroup transaction must be eliminated. Same applies to finance income. These two transactions must be adjusted on the consolidated amount. Additional information number 3, assume that the identifiable assets acquired and the liabilities assumed at acquisition date are shown at the acquisition date fair values as determined in terms of IFRS 3. So IFRS 3 required that before you do consolidation, so if company A wants to acquire company B and the assets and liabilities of company B are not fair valued, it states that first thing first, they must be fair valued. Then you can do consolidation. This is what it's saying. So now they're saying to us here, we can assume that the assets and liabilities of Care Limited are shown at acquisition date on fair values. That's what we want. That's what IFRS 3 say. Additional information number 4, it is the group policy to measure any non-controlling interest at its fair value. Remember, this you can read additional information number 4 together with additional information number 1. I've indicated that here the non-controlling interest is the fair value amount is 137,500. So we're going to use, now they're just confirming that it is the accounting policy to use fair value. So we're not going to use share of proportionate method as we used in class example number 1, which we did on Monday. We're going to use this fair value 137,500. Additional information number 5, Penn Limited granted the loan to Care Limited on 30 June 2019. The loan bears interest at a market-related interest rate of 10% per annum and is repayable on 30 June 2021. Again, any transaction that happens between the two companies, think of intergroup transaction. So it's transaction that the two are doing. When it comes to consolidation, they're saying to us that we must eliminate it. We must eliminate it. So here they just told us that there was a loan granted to Care. So if I go back to the statement of financial position here, because there's no loan amount given there. If I come back here and come back to trade and other payables, you could see that there's a 60,000 amount. This will be the loan amount granted. And this loan amount, I can tell you now. Remember, I indicated that when you start consolidating, and if I come to trade and add 60,000, that's the starting point. Like items, which are liabilities. So I'm going to add the two. But because I know that additional information that we read is just telling me that this amount relates to the loan. So this amount is telling us here. Additional information number 7. Care Limited sold inventory to Penn Limited. The amount of sales between the two companies amounted to 400,000. Let's stop there. Let's stop there. This is where I'll spend most of the time. So this exercise, when I chose it, I want us to deal with the sale of inventory between the two companies. Starting point, the other one got inventory, the other one recognized sales. So what are we going to do? We need to reverse that transaction, that sales, because according to consolidation procedures, it says to us that if there's a transaction between the two companies, it must be eliminated. We'll talk to that regarding the calculations, showing the journals as to what will be the impact. But I can tell you that now, there's a sale of inventory between subsidiary as well as the parent to the value of 400,000. So this is the sales amount that was recognized. Care Limited maintain a constant gross profit percentage of 35% on sales. Additional information number 8, Penn Limited has the following inventories on hand that were purchased from Care Limited. 31st December 2018 is prior year. 31st December 2019 is current year. What are we going to do with this inventory? So I'm going to tell you now that the most important things when it comes to the value of inventory on hand, we need to determine and realize profit and eliminate it. We'll deal with that in calculations. The last part, or additional information number 9, on 1st January 2018, Penn Limited purchased plant from Care Limited at a carrying amount plus premium of 9,000. So now again here, there's a sale of plant between the two companies. So we need to eliminate that as well. And they're giving us information, say Care Limited has purchased this plant on 1st January 2015 for 110,000. Penn Limited agreed with the remaining life of the plant. So they will continue with the remaining life of the plant. depreciation on plant is at a rate of 10% per annum on the reducing balance method with a residual value of 10,000. Depreciation is included as part of other expenses. So depreciation recognized for this sale, we need to eliminate it. We'll spend more time on that. So this exercise, I want to spend more time on that one. Loan, we dealt with it. Dividend, we dealt with it in the previous class example. Lastly, assume the tax rate is at 30%. So the next slide again is the required. So it's quite a big question, but we can break it down and see as to where do we start and what is the easiest way. So what is required is the analysis of equity of the subsidiary. They want us to prepare the consolidated statement of comprehensive income, consolidated statement of changes in equity. So if I was writing this question, I was going to start by consolidated statement of comprehensive income, just add revenue line items, cost of sales line items, other income line items, just add the likes. That's what I was going to do before I do anything else. Just add, because by just doing that, you earn marks. This is what I'm referring to. Let me show you part of the solution, then we'll go back and look at the calculations for each. Here is what is required here. So consolidated statement of profit and loss. This is what I was referring to. First thing first, I was going just to add. This is the information provided on the example. You just add for the two companies before you deal with any movement. You just add. Then on its own, it also saves you time. So you just add. So, but nevertheless, let us just take a minute and look at what are some of the takeaways on this example. So we acquired 80% of the shares. The class example told us that non-controlling interest is measured at fair value. The year end is 31st December 2019, and there's a lot of intergroup transaction. Dividends received, loan between the two companies, finance income, sale of inventory, so, and also the inventory on hand that we have, and as I've indicated, unrealized profit on opening and closing balance needs to be reversed, and the sale of property, plant, and equipment. So most adjustments are going to get them here on this intergroup transaction. And one of the key issues, they say intergroup transaction must be eliminated. It is the consolidation procedure. So now, as I've indicated in the previous class, I say when you prepare the analysis of equity, there are three important dates. At acquisition, so that is the day where the transaction happened, where you acquired shares of the other company. So there's a transaction you need to process there. And there's since acquisition and current year. Those are the 3 days that you need to deal with when you deal with the analysis of equity. So first thing first, let's look at acquisition. So I did it by using the journal, but I just want to explain. After a year, then we'll go to the analysis and see all these figures as to how are they presented on the analysis. So at acquisition transaction, so first thing first, every procedure that has been mentioned here on the consolidation procedure, we're going to see it there. Starting here, eliminate the carrying amount of the parent, eliminate parent's portion of equity of each subsidiary, recognize non-controlling interest, and recognize goodwill. We should be able to see it here. So if I come to that journal here, all this information is given. So if you go to the class example, the equity part of the subsidiary was given. It was given. Share capital, 50,000. Retained earnings, 400,000. Market to market reserve was 1.5. All these, when I read my consolidation process, they said they must be eliminated. Whatever I put in red, I just did for the sake of explanation. When you write them, you don't need to indicate that, but these are eliminated. Think about it. Share capital. Share capital is an equity account. Equity account increases on the credit side. So when you eliminate it, that's why we're debiting it. All these are equity accounts, and in order to eliminate them, we must debit it as at acquisition. So we need the figures at acquisition, which was given at the beginning of class example, as it is. Now let's move to the investment. Investment is an asset, and I've shown you where investment has been indicated in the statement of financial position, 425,000. In order to eliminate asset increases on the debit side. In order to take it out of the asset book, we credit it. All what we're doing, we're following that consolidation procedure. Then non-controlling interest, they say we must recognize it. And at this stage, we're using fair value, 137,500. We were given at additional information number 1. So now, what does this mean? How do we determine whether we have a goodwill or bargain? Very important. So now, this is how we need to determine whether we have a goodwill or bargain. So if you add 425,000, and you add 137,500, you will have 562,500. And the difference, if it's going to be on the debit side, it will be your goodwill. If it was on the credit side, then it was going to be your bargain purchase. So now all this information that you see here, we should be able to see it on the analysis. I'll go to the analysis. Share capital, 50,000. Retained earnings, 400,000. Marked to market reserve, 1.5. But bear in mind, we only acquired 80%. So if you convert all those amounts to 80%, then share capital is going to give you 40,000, retained earnings 320,000, and market to market reserve 1.2. So it's going to give you a total of 361,200. How much did we pay? We paid 425,000. So the equity value was 361,200, but we paid 425,000 more. That means then the difference what we paid, it's goodwill. That's how we determine goodwill. 10,000 is 20% of 50,000, 20% of 400,000, and 20% of 1.5. This 137,500 is now controlling interest. It was given. Overall, goodwill is 111,000. And if we are required to prepare the statement of financial position, this will go under asset section as goodwill. So this is the analysis at acquisition. Remember, I said there are 3 important dates. At acquisition, this is what we need to determine as to how much was our goodwill, non-controlling interest, consideration that we paid, which was 425,000 in terms of 80%. So we paid goodwill to the value of 63,800. Since acquisition, I'll go back to the calculation, then we'll go back to since acquisition. Since acquisition, there are various transactions that is going to happen at since acquisition. So first thing first, let's deal with retained earnings. So you will agree with me here, at acquisition, we had retained earnings of 100,000. So when we acquired this company, we had retained earnings of 400,000. But when you go to the statement of changes in equity, the opening balance of retained earnings of the subsidiary was 508,000. This is given on the statement of changes in equity. So now, if it is not given and you're only given the closing balance, you must work it around. Look at class example 1 as to how we work around it. But in this case, it was fortunate. If you look at the statement of comprehensive income, 508,000 on the subsidiary as well as on the parent, this amount was provided. So here is the movement. So since acquisition, we're more interested in the movement. Initially, it was 400,000. 9 is 508,000. So there's a movement of 108,000 when it comes to retained earnings. So if I go to my analysis of equity, under retained earnings, here are the two amounts that I was talking about. 508,000 less 400,000. We recognize the movement. I just wanted to indicate as to where do we get those amounts from. We got those amounts from, this is at acquisition. This is from statement of changes in equity, the 508,000. Now, since acquisition, we had closing inventory 2018, and we're preparing the books of 2019. So 2018 is prior year. So if it is prior year and now we're doing consolidation, we need to determine what we call it unrealized profit. So you'll agree with me that when we deal with inventory, we deal with inventory and cost of sales, right? But if you look at my journal here, I've debited retained earnings. Remember, each and every line item on the statement of profit and loss, once they close it, it goes to retained earnings. So when you're dealing with the prior year, you must use retained earnings account because everything has already been closed there. Okay, let me put it this way. So in normal circumstances, what I'm saying here is, if I want to eliminate inventory that we have on hand, inventory is an asset, right? So if I want to eliminate it, I'll credit it. Yes, here I'm crediting it. You can see that inventory is going to decrease. Don't worry about the amount for now. I just want us to explain the principle as to what are we doing. So inventory credited. We're happy with that. So the amount here, when we say retained earnings, we're referring to the cost of sales that goes hand in hand with inventory. But because it's prior year, we use the retained earnings account, not the cost of sales. So in other words, what I'm saying here is that when we go to 2019, because you'll be current year, you will see we're going to debit cost of sale and credit inventory. And why are we doing this? What we're saying, we say these transaction companies that can be into the adjustment. So in order to do that, we're going to reduce our earnings here, and then we're going to reduce. Now we consider the part of it because this 30,000 was the closing amount. So you take then it's called unrealized profit on profit and loss. Then we're going to take 10,500 multiplied by 30% will be 3,150, and we'll do the same with 3,150. So this transaction, if you go to since acquisition, we should be able to see the net effect. So retained earnings is going to be reduced by 10.5, and retained earnings is going to be increased by the tax portion of 3,150. I'll quickly go to the analysis here. You will see that retained earnings is reduced by 10,500, and retained earnings is increased by 3,150. This is where these figures are from. It's for prior. Then I will deal with the inventory for the current year at the same time. So I'll go to current year. Don't worry about my calculations. As long as I can explain it, makes sense. Current year inventory 2019. Here we talk about cost of sales now because it's current year. We're no longer talking about the retained earnings. Cost of sales, debit, credit inventory, 40,000, which is the closing amount, multiply by 35, give us 5, and then we do the tax on it. Then we'll have deferred tax of 4.2 and income tax of 4.2. So to see this transaction on the analysis under current, remember we deal with the date. Current year profit. I have to see the 15,000, which will be subtracted, and the 14,000, which is cost of sales, which will be subtracted, and then the income tax part of it, 4,200, must also be subtracted. Here's the 14,000. So on the same token, because I'm dealing with current year, so if I go to my consolidated statement of profit and loss and other comprehensive under cost of sales, we must see addition of and add on income taxes less 4. So this is what I'm referring to. If I come here to cost of sales, 14,000, which I was talking about, we dealt with it there. And if I go down to income tax minus 4,200. This is where we get this amount. So all those intergroup transactions, as we deal with them, then they impact our consolidated statement. I wanted us to deal with inventory first so that we can finish inventory and we move on. Retained earnings, inventory, since acquisition, and current year, I spoke about it. Now, another additional information, property, plant, and equipment is to deal with the there was a property, plant, and equipment, which was a plant this time around, sold between the two companies. And how do we do that? We're more interested into the unrealized profit and the tax part of it. How do we determine that? The cost was 9,000. Depreciation for 2018 was 900. That means the carrying amount was 8,100. The tax part of it corresponding with it, 900 multiplied by 30%, 270, and we have 2,430. So in order to reverse that transaction, again, because depreciation portion part of it goes to equity, you're going to reduce your equity by the carrying amount of 8.1, and you're going to debit your PPE by 8.1. And you do the same when it comes to the tax, you use 2,430. So what does that mean? If you go at since acquisition under retained earnings, your retained earnings is going to decrease by 8,100 and it's going to increase by 2,430. Here's the amount that I'm referring to, because if you come here, you just see the figure. Here it is. Minus 8,100 plus 2,430. That will be your total of retained earnings since acquisition to the beginning. Once you get this figure, then the rest will be easier, because then you will have your since acquisition multiplied by 80% and then multiplied by 20%. Market reserve, you will do the same. It will be the at acquisition until since acquisition. We'll look at the calculation with regard to that in no time. This part was given, we don't need to worry about it, but this is what at acquisition it was 1,500. Since acquisition, 12,000. Here's the 12,000, and here's the movement. Here's just the breakdown of how it will look like on the analysis. 80%, 8.4, 20%, 2,100. Here's the 12,000 less 1.5. As I explained in the calculation, it's going to give us 10,500. Marked market reserve, you must put it on its column on its own. At since acquisition, 8.4 and 2.1. So far, so good. Up to so far. So now we need to go and deal with the current year period. We've already started dealing with that. Eventually, to explain the PE. So PE 2019, it means the amount needs to be returned off from the PPE. So this is the journal. PPE 7,290. So when you preparing the consolidated statement of financial position, if it's required, this amount needs to reduce our PPE because it is the intergroup transaction between the parent and the subsidiary, and we know the processor eliminate it. But what is more important is here. So normally depreciation is an expense. Expenses increasing on the debit side. So in order to eliminate it, you credit it, depreciation, and the corresponding account, the accumulated depreciation, where you debit it, 810. We just calculated the 810 there, and you will determine the tax part on that. So what I'm expecting is that if I go to my statement of other comprehensive income under other expenses, 810 must be subtracted. And if I go to income tax expense, it must be added by 243. Let's check that. If I come here, other expenses, 810, that is the depreciation for the current year. Income tax expenses, 243, that is the tax expense and depreciation for current year. We are eliminating. So all these adjustments, most of them that you see here, has to do with intergroup transaction. But don't forget what is important. First thing first, you combine the like items, and then you can do the adjustment. I think we're progressing well. This last part I want us to discuss, and then it will conclude this. Dividends, as I've indicated, also is part and parcel of intergroup transaction, but more importantly is that we're dealing with the 2,000 that was shared between the two companies. This was given on our information. I just passed the journal here to indicate that in your statement of profit and loss, your dividend needs to be reduced by 32,000. If I go to other income, I must see 32,000 being reduced because it is dividends. Other income, 32,000 being reduced. This 3,000 is that finance income because it's between the two companies. It must be reduced as well. The last part, let's look to the loan now. Think about the loan. The loan value is indicated to a 60,000 between the two. It needs to be reversed or eliminated. And then the interest part of that, you will have the interest income. The other part, company will be receiving interest income. The other one will be charging interest expense. So the 3,000 needs to be eliminated. How do we calculate it? 60,000 at 10%, that will give us 6,000 because it was entered half yearly, then multiplied by 6, divided by 12. So if I go to other income, as well as other expenses, I should be able to see this deduction of 3,000 on the statement. Other income, 3,000. Finance cost, because it's interest expense, 3,000. So the remaining part is just a combined part of it. Statement of changes in equity. Once you deal with this, then statement of changes in equity, it will be easy to deal with the movement on the statement of changes in equity. Then from my side, that's all I have, unless you have any question. The recordings of these will be sent once I receive them, and just check if it was recorded properly. Then I'll send the link via the class rep. I've sent already these slides. I believe you received them. If not, then the class reps could assist with regard to that. I see that we only three. Thank you very much for coming through, guys. And just remember that on Thursday, tomorrow, you're writing assessment number 2 and assessment number 3. I think you're going to write on Saturday, and it will be based on consolidation.